Hood closed the week at 75.95. And if you just glanced at the chart for 2 seconds, you might think, oh, it's stabilizing. The weekly printed a green candle. The bleeding slowed. The panic cooled. Everything looks respectable. And that's precisely what makes it suspicious. Because after weeks of gravity doing its job with enthusiasm, the stock didn't reverse. It didn't reclaim anything meaningful. It didn't scream strength. It simply stopped falling aggressively. And that is not the same thing as a bottom, no matter how badly we'd like it to be. It was a short week. Volume came in slightly below normal, but not dramatically so. And the tape felt like a room full of traders pretending they aren't waiting for someone else to make the first move. Nobody rushed in. Nobody stampeded out. The stock hovered. And hovering is one of the most uncomfortable behaviors a beaten-down chart can display. When panic disappears without conviction replacing it, you don't get clarity. You get tension. Quick reminder, I am not a financial advisor. This is not financial advice. And this show is for entertainment and parody purposes only. If you are placing trades based purely on sarcasm and dramatic pacing, at least hydrate. Even Wall Street seems to understand the mode. 3 analysts reiterated their buy ratings: Goldman, Truist, and Mizuho. But all 3 lowered their price targets by about $30. That's not bearish, it's just emotionally cautious. It's the financial equivalent of saying, we still believe, we're just going to stand a little further back. Nobody walked away from Hood. They just recalibrated their expectations. And that word, recalibrated, might be the most accurate description of this entire setup. The filings didn't add fireworks either. The annual 10K dropped. An S8 for the employee stock purchase plan showed up. Then a 10K amendment routine, procedural, responsible. The CFO sold about 5,400 shares and still holds over 51,000, which isn't dramatic enough to cause alarm, but is just noticeable enough to add seasoning. And in a quiet chart, seasoning tastes louder. Now zoom out to the weekly, because this is where the psychology really reveals itself. That candle is tiny. It's green, yes. And after weeks of red, that technically counts as progress, but it's tiny. Momentum hasn't flipped. The 50 EMA is still trending downward like it's committed to pessimism. Price is sitting directly on the 100 EMA, as if someone drew a line and said, all right, make a decision. This doesn't look like strength. It looks like exhaustion. Hood didn't bottom. It just stopped falling aggressively. A real bottom feels decisive. This feels like a stock catching its breath after tumbling down the stairs and trying to act like it meant to sit there. Then you move to the daily, and that's where things get awkward. Price has been creeping up, not launching, not reclaiming territory dramatically, just inching higher. Meanwhile, momentum curled quickly enough to already be flirting with overbought conditions at the lows. That's not how powerful reversals usually behave. They build pressure slowly. This one jumped straight from despair to maybe, which feels less like confidence and more like nerves. And then there's the quiet little technical detail that deserves more attention than it's getting. The 50 EMA and the 200 EMA are now touching. That doesn't happen randomly. When short-term and long-term averages compress like that, price rarely drifts politely afterward. It chooses. The daily isn't breaking out. It's negotiating. And negotiations always end with someone conceding. Meanwhile, the options chain is not behaving politely at all. Into the February 27th expiration, the implied move sits at plus or minus $6.60, which puts the expected range roughly between 69 and 82. The largest put open interest sits at $70 with about 3,100 contracts, followed by 75 with around 2,300. Reasonable defensive positioning. But the calls tell a different story. $90 holds 7,500 contracts. 85 holds 4,600. That's not hedging. That's ambition. That's traders positioning for expansion, not drift. And here's the tension. The options market is pricing movement, while the chart itself is pricing hesitation. Someone is leaning early. Someone is leaning hard. And someone is about to discover whether stabilization was a base or just a pause before gravity resumes its shift. So the real question isn't whether Hood printed a green weekly candle. It's whether that green candle represents conviction or fatigue, because there is a massive difference between a stock that has bottomed and a stock that simply stopped falling aggressively. One signals strength, the other signals a breather. And right now, this feels like a breather. If you think this is base building, say it. If you think this is just a controlled pause before another leg lower, say that louder. Either way, calm charts are rarely innocent. They don't explode out of nowhere. They build pressure quietly first. And Hood, whether it's going up or down next, is absolutely building pressure. If you enjoy overanalysis wrapped in controlled sarcasm, subscribe. We cover Hood every week, loud weeks, quiet weeks, and weeks like this, where the silence feels heavier than the selling. Remember, this is not financial advice. Calm charts are suspicious. Explosions don't start with noise. They start with pressure. And right now, Hood feels like pressure. See you next week.